you have questions about fixed income and the current bank environment, we have answers. Brent Wilsey of Wilsey Asset Management joins me right now to discuss. Good morning, Brent. So good to see you as always.
Good morning. Good to be here.
All right. Help us understand this. What is the tool for the job?
Yeah, well, the tool for the job is people concerned now with banks and so forth. I will, say that the banks are safe, your money's safe in the banks, but maybe you have more than the $250,000 limit. You're kind of concerned on that. There's other avenues you can go, and it's called fixed income. And people say, well, what is fixed income? It's income that's fixed as opposed to variable. The big thing that people get excited about are T-bills. And T-bills are short-term maturities issued by the government. So they're up to $5 million denominations. They start at $1,000. They're guaranteed for a certain time frame. You can do it in 1 month, 3 months, 6 months, 1 year T-bill. And I do want to point out, people getting a little confused saying, oh, I'm getting 5% on that 6-month T-bill. Well, that's not 5% for 6 months. It's annualized for 5%. So a lot of things people get confused on. And I always say that we're drowning in information, but we're starving for wisdom. So we have to understand this stuff a little bit better.
There's a list of things that we want to discuss. So from the T-bills to Treasury notes.
Yeah, Treasury notes are longer term. They will go to 10 years. Your bond will go out for 30 years. They're longer term maturities. They will lock in that rate longer. But right now, we're in what we call an inverted yield curve, to where short-term rates are higher than long-term rates, concerned about a recession coming up. So unless you really need to lock in that longer-term rate, you don't want to do a 10-year note or 30-year bond. You want to stay short-term maturities.
So what is the difference between Treasury notes and Treasury bonds?
Bonds are much longer. Bonds go out for 30 years, and there's no reason for an individual investor to have those. Those are generally for insurance reasons, where you got to lock in that guaranteed rate. You need to know what it is for the next 30 years. I don't see any use for a investor, normal investor, doing a bond there for 30 years, even more than probably 2 years.
And a part of the conversation would be corporate notes.
Yeah, corporate notes are also different, because when you're working with treasuries and so forth, you're not concerned about them paying them back. You go into corporate notes, corporate bonds. Now you're concerned on, can they pay this back? And this is where we get the credit rating agencies involved. You want what's called a AAA rating. That's the safest you can get. So you want to get that to get the return. Now, when you go the safer route, AAA rating, you won't get a high of a yield. You go down the curve, we call it. You go down to A, B, triple B. Below that, you're below investment grade. Now you're going to get higher yields, but your risk is higher because that company, that corporation, may not be able to pay it back. So be very careful if you go the corporate route, what the rating is on those bonds, and also the maturity. The longer maturity, the more fluctuation you'll have on that bond as rates go up and down.
And now let's talk about CDs. How does that play a part?
CDs are just certificate of deposits. Now, there's a couple ways you can get those. Normal way, you go to the bank. You go to the bank and you say, I want to put my money in a CD. And you can do that for 3 months, 6 months, 2 years, whatever you want to do it for. There's also a thing called brokerage CDs. Sometimes banks are looking for money. They'll offer higher yields by going through the brokerage firms to actually get a higher yield. Now, the problem with that is that you're going to then get the market value. So say you need the money early, rates went up, you could get a lot less on that CD than if you went to the bank. Banks do have penalties if you need it before the maturity date, but they're very safe. You do have that limit of that $250,000, but they're very safe and they're for short-term maturities.
You also want to talk about mortgages.
Mortgages are on the other side, because we all pay our mortgages. Well, on the other side, somebody has to hold that investment. Now, the difference with those, you can get a higher yield on the mortgages, and they're also called Ginnie Mae's, Fannie Mae's, different ones from the government that are guaranteed as well. But the difference is you have to realize when you're getting back that payment every month, you're not getting just interest. You're getting principal and interest. It's the opposite side. When you pay your mortgage, you pay principal and interest. If you hold an investment mortgage or even a bond fund like that, you'll get back principal and interest. So don't think like, wow, I'm getting all this money. No, you're spending part of your principal. So very careful when you're getting mortgages directly from companies.
And I wish we had more time to talk about the tax-free funds and the bond funds, but we appreciate you helping us understand what fixed income is. And this is like a finance business 101 course for us.
Yeah, it's so important right now because people are afraid of banks, whatever going and so forth. So I want to give people information on what to do. And I wish we did have more time, but I think we got quite a bit in there for people today.
Well, Brent, always so good to see you. Thank
you too,
so
Teresa.
much. Have a blessed Sunday. Thank you.